Today, we're diving deep into one of the most debated stocks of the decade, Tesla. Once the undisputed leader in electric vehicles, autonomous driving, and futuristic product ambition, but now facing a very different set of challenges. A new analysis released by Trefis suggests something bold. Tesla's stock may need to fall toward $274 to reflect current fundamentals. And today, we're unpacking exactly why that idea isn't as far-fetched as it sounds. Let's break it down factor by factor. 1. The big picture. Why analysts are turning cautious. Tesla still sits at an enormous $1.3 trillion market cap, a valuation that implies hyper-growth, dominant profitability, and an unrivaled competitive moat. But the reality on the ground tells a different story. According to the report, Tesla's vehicle deliveries have shrunk 6% over the first 9 months of 2025. That may sound small, but for a company priced like a high-growth tech giant, even slight contraction matters. Margins are compressing, competition is intensifying, and the Cybertruck, once expected to be Tesla's next breakthrough, has turned into what analysts describe as a commercial disappointment. Add to that Google's rapid advancements in autonomous driving, and Tesla's formerly unchallenged leadership in self-driving tech is no longer a certainty. The report's conclusion is simple. Tesla is still a strong company, but the stock's valuation no longer matches the risk-reward profile. 2. Valuation. Extremely high even for a growth giant. Tesla's valuation metrics sit dramatically above broad market averages. That's not inherently bad. Premium companies deserve premium multiples, but only while growth is accelerating. Tesla's growth, however, has begun to stutter. The report points out a 9.3% average top-line growth rate over 3 years, and a minus 1.6% revenue decline over the past 12 months. If a company is priced like a rocket ship but starts behaving like a commercial airline, the market usually reacts. And that's where Tesla finds itself today. 3. Growth. Unstable and losing momentum. On page 3 of the report, revenues fell from $97 billion to $96 billion over the past year. Quarterly revenues did rise 11.6% year over year, but investors are asking whether that growth is sustainable, or just a short-term bump. The competition provides clues. Hyundai, BYD, and European automakers are pushing aggressively into EV markets. Google and others are encroaching on the autonomous driving frontier. Tesla's aging lineup, Model S, Model X, Model 3, and Model Y, now faces mature market conditions. For the first time in its history, Tesla is no longer the default innovative EV choice. 4. Profitability. Falling behind expectations. Tesla's operating income over the past 12 months was $4.9 billion, a margin of just 5.1%. Net margin, 5.3%. Operating cash flow, $16 billion, or a 16.5% margin. These numbers aren't bad, but for a company valued at over $1 trillion, they're not good enough. Consider companies with similar market caps. Apple, Microsoft, Nvidia. Their margins are dramatically higher, more stable, and tied to recurring revenue streams rather than cyclical manufacturing. Tesla still relies heavily on hardware, a notoriously low-margin business. The expectation was always that software, autonomy, FSD subscriptions, energy, would lift margins over time. That projection hasn't materialized at the speed investors hoped. 5. Financial stability. Still strong. Not every sign is negative. Tesla's balance sheet remains one of the strongest in the auto industry. Just $14 billion in total debt. A cash-to-assets ratio of 31% with $42 billion in cash or equivalents. This gives Tesla resiliency. It gives optionality. It gives runway. But even with financial strength, the stock price still has to reflect growth realities. 6. Downturn resilience. A weak spot many investors overlook. Tesla has a pattern. When markets fall, Tesla tends to fall much more. During the 2022 inflation shock, Tesla plunged 73.6% from peak to trough. The S&P 500 fell only 25.4% in the same period. During the 2020 pandemic crash, Tesla fell 60.6%. The S&P 500 dropped 33.9%. Tesla does bounce back quickly, but high volatility is a risk profile that long-term investors must price in, especially when growth slows. 7. The Cybertruck problem. The report states clearly that the Cybertruck is turning out to be a commercial disappointment. This matters for two reasons. Cybertruck was supposed to be Tesla's next big growth engine. The US truck market is enormous, dominated by Ford, Chevy, and Ram. If Cybertruck doesn't scale, and early data suggests production complexity and demand mismatch, Tesla loses access to one of the highest margin segments in the auto industry. 8. Autonomous driving. Leadership challenged. The report makes a striking observation. Google's advancements in autonomous driving have made it clear that Tesla no longer holds uncontested leadership in the self-driving race. While Tesla has brand recognition, Google's approach, sensor fusion, LiDAR, HD mapping, may be better suited for regulatory approval and mainstream deployment. If Tesla is outpaced here, one of its biggest future valuation pillars weakens. And so why $274? The article doesn't provide a specific model, but the logic is straightforward. Growth slowing, margins tightening, competition rising, Cybertruck underperforming, autonomy leadership challenged. Combine these and the market may need to reprice Tesla closer to a risk-adjusted fair value. A fall to $274 wouldn't imply Tesla is failing. It would imply Tesla is maturing. For a company transitioning from disruptor to incumbent, that isn't a disaster. It's reality. 10. Investor takeaway. Is Tesla still a buy? Tesla remains one of the world's most influential companies. Its balance sheet is strong. Its brand is powerful. Its long-term ambitions are intact. But the stock? The stock may simply be ahead of its fundamentals. The Trefis conclusion is unambiguous. Tesla is not attractive at current valuation, and a pullback toward $274 is plausible. For investors, this means that if you own Tesla, reassess your weighting. If you don't own it yet, patience may pay off. If you're long-term bullish, volatility could provide better entry points. Tesla has changed industries before. It may do it again. But for now, the valuation needs to catch up to reality.